Hi, everybody. I'm Brad Cruz. I'm the Associate Vice President of Alumni Relations at Case Western Reserve University, and welcome to our 17th installment of Spartan Step Up. Spartan Step Up actually started during the pandemic. It was a way for us to build our community, let you know what was going on campus, and also let you know what was going on in the community. And we have featured students, we have featured alumni, we have featured professors, and we've featured staff. Today is one of those episodes where we're featuring staff. So today, three of my colleagues are going to have a conversation with double alumna Susan L. Friedman. My colleagues are from the Office of Strategic Giving. The Office of Strategic Giving provides support and guidance for CWRU's friends and alumni as they navigate charitable giving, from scholarships and professorships to research and program development. The Office of Strategic Giving is your one-stop shop for the who, the what, the where, the when, the why, and the how of giving to Case Western Reserve University. Let me tell you a little bit about my colleagues. Amanda Penny, she's the Assistant Vice President of Strategic Giving, and she's a graduate of CWRU Law. Kristen Rothman is the Strategic Giving's Associate Director. And also you have Ellen Halpin. Ellen is the Senior Philanthropic Advisor for CWRU. Today's conversation's guest is Susan L. Friedman. Susan is a partner with Corman and Jackson and Krantz. Susie holds a bachelor's degree in political science from Washington University in St. Louis and earned her JD in Case Western Reserve University School of Law. And if that wasn't enough, Susie also holds a master's degree in social work, which helps her to address and resolve various issues her clients face. Susie is involved with the Jewish Federation of Cleveland and sits on the board of the Cleveland Hillel Foundation. She's also a member of the University Hospitals of Cleveland's Diamond Advisor Group. In her free time, Susie enjoys walking in the metro parks near her home in Solent, spending time with her two daughters and her 6-pound Yorkie, Louie. She also plays tennis, goes skiing, and loves reading fiction. So I'm going to pass the reins over to Amanda to start the conversation. Again, this conversation is who, what, when, where, why, and how of non-cash gifts. Take it away, Amanda.
Thanks so much, Brad. And thank you, everyone, for joining us today. As Brad said, I'm Amanda Penny, the Assistant Vice President of Strategic Giving at Case Western Reserve. Our goal today is to share some ideas with you about how gifts of non-cash assets can help you fulfill your charitable goals. Some of you did submit questions when you registered, and we're going to try to get to all of those today. We plan to cover them in the last 15 minutes. If we're not able to respond to your questions, don't be worried. We'll make sure we follow up with you directly after the Spartan Step Up to make sure that you've got everything answered. Also, please feel free to enter your questions in the chat. We'll also be monitoring the chat and keeping track of those questions and making sure you get those answers as well. Now I'm going to turn it over to Kristen Rothman. Kristen, take it away.
Thanks so much, Amanda. Today we plan to cover tax beneficial ways you can make charitable gifts of retirement assets, marketable securities. We'll also touch on real estate, which is a question that did come up during the registration process, so thank you very much for submitting those questions. We'll also provide an overview on how you can use these assets during your lifetime and as part of your estate plan to make a gift to the university. For each of these topics, and I think we have a slide, we'll cover the what, so what is the asset? When and why might you consider using the asset to fund your gift? How, some practical tips for the process and steps related to getting that gift to the university. Who can best guide you, whether that's an attorney, a tax advisor, and helping you make that decision. And then the wow, so some real examples of real people who have made gifts using these assets in the past. Finally, we're going to provide you with an example of how a donor can or has used the asset in a meaningful way. And then we know there are a lot of options to consider out there. So gifts of life insurance, charitable gift annuities, and then tangible personal property. We're not going to be able to cover all of these today, but we will definitely cover those in future sessions, and we hope you'll be able to join us for those. Finally, we'd love to hear your ideas and suggestions on topics for other sessions in the future. So if you'd like to include that when we send out the follow-up survey after this session, we'd greatly appreciate it. I'm going to turn this over to Ellen Halpin, our Senior Philanthropic Advisor, to start the conversation with our guest, Susie Friedman.
Thanks, Kristen. And welcome. We can't see all of you, but we're really glad that you're joining us today. So we're going to start with the what, when, who, what, when, where, why of gifts of appreciated securities. So let's start with the what. What are we talking about when we talk about marketable securities? We are today talking about marketable securities. These are securities that have a readily available value on New York Stock Exchange or on NASDAQ. We're not talking about closely held assets like partnership assets or closely held corporations, which we can also handle, but that's not for today. So when and why might you consider using these assets to make a charitable gift? One would be if they have significantly appreciated since you've bought them. And you've held them for more than 1 year, so that if you were to sell them, you would incur significant capital gains. Perhaps they're providing little or no income to you, and you're just sort of ignoring them in your portfolio, and you're looking at what assets you might want to give. Or if you're anticipating a liquidation event for the company in which you own the stock, and you want to avoid the capital gains. So what would be the tax benefits of giving that type of an asset? So if you itemize your deductions, you would get really two benefits. You would be able to take a charitable deduction for the full fair market value of the asset. It would be deductible up to 30% of your adjusted gross income. And if that's a large gift, you can carry it forward any excess for 5 years. The other benefit that you get is avoiding the capital gains. So even if you don't itemize and cannot use the charitable income tax deduction, you can still benefit from using this type of an asset because you will not incur the capital gains. And we're going to show you some examples in a little bit, but I'm going to turn to Susie, who is a really experienced estate planner, works with individuals like all of you with their charitable planning and estate planning. Susie, welcome.
Thanks.
And I wondered if you could share with us perhaps some examples of situations where your clients might have benefited from using appreciated securities to do their charitable giving.
Absolutely. And first, I just want to say thank you to the team here for having me here and being an alum. It's very meaningful for me to participate in this program. So yes, I work with a lot of clients who do make gifts with appreciated assets, marketable assets. Just off the top of my head, one family I worked with recently made a very impactful gift to a local nonprofit because they inherited and held large blocks of inherited stock. The stock needed to be diversified, and they realized it was a good time to make this gift to an organization that impacted their lives. By making this gift, they incurred tax benefits by reducing their capital gain, just as Ellen explained, and they also were able to take a deduction at the same time. So it was really a win-win. Similarly, I have clients who are corporate executives, and corporate executives often hold significant blocks of stock or stock options. I'm always encouraging them to diversify those blocks of stocks. And again, for my clients who are often charitable-minded, this is a great time to work with their financial advisors and their CPAs and me to figure out how to make the most impact and at the same time avoid capital gains and take a deduction.
Well, that's really helpful, Susie. A second question for you. When is it sometimes a good time? I mean, obviously the situation you've just described when they have a large block of stock, but in terms of timing to think about when to use stock for charitable giving, do you find that there's a particular time perhaps when they're reallocating their portfolio that this might come up?
Yes, so that's sort of going along with diversifying and reallocating. And, you know, my clients and individuals reallocate for different purposes. Often maybe they need more income, less income. But that's a really good time to look at what they've got and then consider where the gains are going to be. And if it makes sense to make a gift at that time to avoid some capital gains.
And then have you sometimes even found, particularly with the volatile market that we've had, I know some individuals have decided to, they might decide to sell off some depreciated stock, and how would that maybe play in?
Right, well, absolutely. So if they sell off some depreciated stock, that can alleviate, what the gain would have been on another stock, and then they can make a gift and take the deduction of the cash proceeds. So they can do that as well.
Right, so that can be a win-win. Amanda, why don't you take it away with the scenario that we have to present to our guests?
Thank you, Ellen. We thought it'd be really helpful to throw some scenarios at you that you could probably relate to and maybe see what it looks like in real time. So we're going to put a slide up here about Arthur and Carol. On a rainy day in 1975, Arthur and Carol literally ran into each other, rushing to class in Nord Hall, and have been together ever since. Shortly after graduation, Arthur bought stock in PropTopica for $1,000. His shares are now worth $10,000. As a scholarship recipient himself, Arthur would like to make a $10,000 gift to Case Western Reserve University to support students. What should he do? We're going to turn over to our experts. Ellen and Susie, what should they do?
Can we go to the next
We can.
slide?
So we're going to put a slide up here too, just to show you the math, and thought this would be helpful.
Right.
So let's walk through the slide.
So Arthur, as we said, Arthur and Carol have invested in this stock. It's grown from $1,000 to $10,000. So if Arthur and Carol itemize, they'll be able to take an immediate income tax charitable deduction of $10,000, which if they're in, depending on their bracket, if they're in a 37% bracket, they'll be able to take a deduction for $3,700. As I described before, that deduction is going to be limited to 30% of their adjusted gross income. They can, if you can do the math, if it were a larger gift, they'd be able to carry forward any excess. But even if he doesn't itemize his deduction, Arthur's still going to avoid the tax on the $9,000 of gain. And Susie, could you please run through the
Yes,
chart
the
we have
chart.
here that shows the numbers?
So the chart summarizes what Ellen just said. So if you look at whether it's a cash gift or a stock gift, if you just go down, you can see that both of them, it will be a $10,000 deduction. The taxes saved will be $3,700 for each of them. Because the purchase price, if we look at the stock gift, was $1,000 and it's increased to $9,000. If he donates the stock, then he can avoid the $1,800 capital gain tax, and so the total savings would be $5,500 if he donates the stock versus $3,700 if he does the cash.
Right. And I guess I'd like to sort of point out here that with this planning, there's not, one size fits all. It always is going to depend on the individual tax situation. So while this works out really well for Arthur and Carol, there may be situations where other assets or other options might be better.
That's right.
Thanks so much, Ellen and Susie. Much appreciated. I know it's always helpful to kind of see the scenarios and see some, the math. It always helps go through and maybe some of that you can relate directly to what you've seen here too. The last thing I'm going to share before we turn it over on this topic is the house, the life income options, and some examples too. So how do you make the gift? We put some of these in a quick slide too. Case can work with you, your advisor, or your broker to facilitate the transfer of the securities. But just a quick tip, make sure you allow enough time for your advisor, especially as people look to the end of the year, heavy times, February, April, end of the year, November, December. Make sure you've got enough time. How is your gift valued? The IRS values your gift of securities on the date it's received in our account, not on the date your broker initiates that transfer. So just be careful of that. Recently, too, this has been a hot topic with life income options. Gifts of securities can also be used to create life income gifts that will provide you with an income stream, with the remaining assets passing to Case. And don't forget, the most important part of anything is your gift can fund a gift that furthers your own passion at Case Western. Professorship, program, researcher, scholarship. So never forget that why, because that's what truly matters. All right, we're going to turn it back over to Ellen and Susie, and we're going to switch topics here. We're going to talk about retirement assets. I think all four of us deal with that on seemingly a daily basis, so we definitely know that's a hot topic. So Ellen, can you tell us a little bit about retirement assets?
Sure. So getting back to the what, when, why, like we did with marketable securities, retirement assets are probably it's probably one of the most, common assets that many of us have. Anyone who works in legal profession, medical profession, in an institution like Case, much of our assets are in our retirement assets. Our qualified retirement plans, sometimes called a QRP, that would be your 401k, your 403b, your IRA. We're not talking about Roth IRAs today because Roth IRAs are taxed a little differently. With QRPs, these are the plans that you contribute to over the course of your employment, and you don't pay tax on them. You're contributing pre-tax dollars. You're allowed to put them into the plan. They grow and appreciate free of tax, but of course, there's no free lunch. When they come out, they get taxed. And the IRS does require that we take them out at some point, and they will take their bite. So the rules now are for what are called required minimum distributions. It's been moved up to age 73. You have to take out a certain amount every year. That's calculated by your administrator. And whatever comes out is taxed at ordinary income rates. That's just like your wage income. So it's not capital gains, even if there's stock in there that's been appreciated. So when might you consider using these assets for gifts? So during your lifetime, we now have the privilege, this has been in the law for a while, to be able to use, once you turn 70 and a half, can't do this before that age, but once you turn 70 and a half, you can use something called a qualified charitable distribution, sometimes called an IRA charitable rollover. This allows you to direct your administrator to take up to $100,000 a year from your plan and distribute it directly to charity. It's a win-win from a tax standpoint because you don't pay tax on it. You will never pay tax on that, and the charity benefits. You don't get a charitable income tax deduction for that because you haven't taken it into income, but you will avoid income tax on that distribution. And the other way that you can use your charitable, the QCDs can be used for outright gifts to charity. They now can be used in a limited fashion for some life income gifts, but we're not going to get into that today, but that is something that any of us could talk to you in our office. Retirement assets are also great for giving in your estate. And this is because no matter what you do, unless you're giving it away in a QCD or giving it to charity at your passing, those assets are going to get taxed. So if you're leaving them to family, those family members, whether it's your spouse or your children, are going to eventually pay tax at ordinary income rates. So for estate planning purposes, sometimes if you are looking to do charitable giving, you might consider giving the retirement assets to charity or a portion of those to charity and saving other assets for your family members like appreciated stock or real estate, because when they take those assets at your passing, they will take them with a basis stepped up to whatever the value is at your passing, and they will only pay tax on those assets when they sell them and only for any appreciation after you've passed. So I'm going to turn to Susie and ask her about how this kind of planning has been used by her clients. Do you find, Susie, that your clients are aware generally about the benefits of giving with QCDs? Qualified charitable distribution.
Some of them are, if we've discussed it or they've discussed it with their financial advisors or their accountants. But something that also to touch on is that the Secure Act is a new law from the past couple years where when your beneficiaries do inherit those retirement assets, if they're not your spouse, they have to take those assets over 10 years. So to take all that ordinary income over 10 years and pay the taxes could be a really tough hit. So that is why I'm talking about this even more with them, because it makes great sense where they may not need the income right now, they may not need that RMD, to make a charitable gift with it, so that again, they avoid the taxes. And then, as Ellen mentioned, maybe they can leave a different asset to their kids that are stepped up at their passing, and the kids won't owe taxes when they inherit it. So I do like to use them.
Yeah, and I just realized that one thing I forgot to mention, which is really important with the qualified charitable distribution, is if you are required to take your required minimum distributions, that $100,000 can count towards your required minimum distribution.
Right.
I left that out. That's an important point to remember. But even if you are not yet required to take required minimum distributions, if you're between 70.5 and 73, that is something that you can still use. And a husband and wife, if they have separate IRAs, up to $200,000 between the two of them. Have you seen clients of yours sometimes consider maybe a blended option of using, maybe using QCDs during their lifetime, but still going ahead and using the retirement assets as for their estate planning gifts?
Oh, absolutely. I work with my clients using all different methods for them to leave their assets to their loved ones and to their charities that are important to them.
And have you ever, I know I had a client once who sort of didn't really know yet what they were going to want to do. They wanted to, in a sense, have their cake and eat it too. So they left retirement assets to family, but provided that as a contingent beneficiary, charity was the contingent beneficiary. And how would that work?
That's a really great thing you can do with retirement assets, because you could name both a percentage, or you could name your kids, for example, and then name a charity as a contingent beneficiary. And if your kids don't need that and they don't want to pay the taxes on it, they can disclaim it, and then the assets will go directly to the charity tax-free. So that's a really good question and a very good way to plan.
Yeah. So I'm going to turn this back over to Kristen to give us an example of a couple who use their retirement assets.
Thanks, Ellen. As Ellen said, we're going to share a real-world example about James and Louisa. I think we have a slide for them. James and Louisa have made the most of their Case Western Reserve University education and have had long and successful careers. Their children are all grown and successful in their own right, and now they're reflecting on their time at the university and how they can give back to the university. Louisa was a scholarship recipient when she attended CWRU's School of Medicine, and she really wants to provide scholarship support. She reaches out to our office, hopefully, to discuss how she can use her RMD to start a scholarship. I'm going to let Ellen and Susie discuss this one and talk through how she might do that.
Okay, we have a slide that's going to come up that's going to actually show the numbers. It's always nice to see this. Now, this is discussing a lifetime gift, and this illustrates what we've been talking about. So here we have a lifetime gift. What's really important to note here is that James and Louisa don't itemize their deductions. So this is where using a qualified charitable distribution can be particularly useful for you, because if you make the gift out of cash or even out of appreciated securities, you're not going to be able to benefit from the charitable income tax deduction because you don't itemize. But if you use, you save your cash and your stock for other things and you use a qualified charitable distribution to make the gift, you're going to avoid the income and lower your taxable income for that year. And this shows that they decide they have $100,000 of income before they have to take their required minimum distribution. They have a required minimum distribution in that year of $30,000. And then Susie, if you can run through those numbers and share how this works out so well for them.
So this is great, because if you look at this, If they give away half of it for a charitable distribution, then, at 15,000, then it lowers their pre-tax income by 15,000. They can take the standard deduction, and then their taxable income goes down to 87,700. Whereas if they don't take it, it's 107. So it's just a great way to lower their income and make the gift that's meaningful to them during their life.
Thank you, Susie. We're going to turn this back over to Kristen to share some pointers.
Yes, and just to wrap up this section, just a summary reviewing the benefits here. We want you to remember, if you're taking away this information, it's 70 and a half is that magic age where you can start taking that QCD of up to $100,000 a year. And as Ellen pointed out, if you're a husband and wife or a couple that have individual IRAs, that can be up to $200,000. QCDs can help save on the current taxes, even if you don't itemize, by reducing your overall taxable income. They're initiated by the donor. That's a really important thing. Sometimes we get questions in our office, how do I do this? How do I make this QCD gift? And the important thing to remember is that as the owner of the retirement account, it's you who would have to initiate that. And every IRA administrator has their own process. Some of them have a form. Some of them, it's just a phone call. Some of them have an online portal they want you to use. So it's important to understand what your IRA administrator's process is for issuing that QCD directly to the charitable institution, hopefully to Case Western Reserve University. If you do have check writing privileges, this is a newer thing, you can write that check from your IRA directly to Case Western Reserve University. So you kind of get to avoid a little bit of that process rigmarole that they might have. Retirement assets are also a great way to make a planned gift. You can do this by designating all or a portion of the retirement asset to the university. And then retirement assets are a great way to make gifts during your lifetime and as part of your estate plan. They can be used to save income taxes for you now, and then also preserve more tax beneficial assets like real estate or cash for your heirs. So those are some things that we really want everyone to take away from this portion of the presentation. And I'm going to hand it back over to Amanda, or...
So we are right on time, and I think everybody's really excited about that. We're at the Q&A section, or Q&A portion of the presentation, our fabulous Spartan Step Up. So I'm going to ask our panelists for some final observations, but then we got some really thoughtful and insightful questions too, so I want to make sure we hit those. But at the end of the day, please make sure that if you have a question, we're all available for conversation. Reach out, ask the question. There's no bad question. Every scenario can be unique, and we're happy to run through those with you and see how we can help. So Ellen and Susie, do you have any final observations or things that you want our audience to know as we wrap up?
I also wanted to just mention, our office, we're available for questions, for illustrations. We can also work directly with you and with your advisors. So, we can't give you tax advice, but we can point you in the right direction and help you work with your advisors. So, Susie, I was wondering, do you find that if you have clients who maybe are trying to decide whether to make the gift now or in their estate, and even if they're doing it in their estate, if they're thinking about whether to let the university know of what they're planning, how does that conversation go for you when you're talking to your clients?
It goes where I'm talking to a client and they make known their charitable wishes, interests, passions, and then, I would ask if they've talked to anyone at the university, and I would direct them to the Office of Strategic Giving, to you guys, because you can really help them know where there's giving opportunities, projects that need to be funded, and what really makes the most sense with them and their goals and their interests. So I always would recommend they work with you and that they have a relationship with you and that what their plans are. And then I usually work with you as well, but it can really save time and money with their attorney and their other advisors to go straight to, your office so that you can help them meet their needs and their goals.
Right. All right. Well, Amanda, do you want to share? I know we were going to talk about maybe a specific instance of a situation where a donor's done what we call a blended gift. And in this case, I think it was with retirement assets, and how that ended up being such a win-win for the donor and for the university.
Yeah, thanks, Ellen. So many of these stories are so meaningful too, and it only happens when they come to the office and kind of tell us the scenario and what they want to accomplish. And we have a wonderful gentleman who doesn't have any family left at this point, and realized that, Case made a difference in who he was able to be, what institution he was able to go to, and how he, had the rest of his career. So what he did was he used his QCD effectively. And he called and he said, I'd really like to make a planned gift to the institution, and I'd like to leave the institution my entire IRA. And that's fantastic. And we helped, all right, what's your passion? Your passion is scholarship. What type of students do you want to support? Can we share this with the school so they know what's coming? He agreed to all of that, except that he wanted to be anonymous. So we created the Opportunity with Distinction Endowed Scholarship Fund in his honor, because he thought that was very special. But he said the one thing that really bothered him was that he couldn't see that happen during his lifetime, and he wasn't going to see these recipients. So what we decided to do was, again, use his QCD effectively. So every year, he gives a portion of his QCD to the institution, and we award the Opportunities with Distinction Scholarship Fund in his honor. We share with him the details about who the recipients are, and he gets to see the impact of his planned gift now during his life, and also has, as we've heard today from our experts, some really great tax implications too. So that's one way that you can do something, blended after you pass, but while you're here living as well. So it just makes, as we talked about today, a win-win, but really special for the students who receive it as well.
Well, I think that really illustrates something that, Susie, you see, and that when I was practicing doing what you do, we can talk about tax benefits and tools and, there's this new way of giving, but what it really comes down to at the very beginning, and what's most important, is what the donor's passion is.
Right.
And, then we can always figure out a way to make it happen, and hopefully in a tax beneficial manner. So, Kristen, do you want to head up?
Yes,
we have some wonderful.
We have some great questions that came in.
Great questions that came in.
Both during the registration process, and I think we've had a couple come in through the chat, so that's really helpful. So I'm going to throw these questions out to our panel here and let you all tackle those as you see fit. First question is, which is better, making gifts of highly appreciated securities or RMD, assuming that the income from the RMD doesn't change our tax bracket?
So I love this question because it's almost as if we planned it, because that's what we've been talking about today.
Right.
Exactly, those two different assets, giving appreciated securities or using a qualified charitable distribution, using part of your RMD. Well, the answer, as it often is it depends, because these situations will always depend on your own personal tax situation. But there is a rule of thumb here. There's some generalities we can make. So if you are a person who is not itemizing, you are probably going to do better by using the QCD than the appreciated securities. And that's because, particularly if you're in a high income bracket, say you're at 37%, you're going to save 37% of your taxes. If you used the appreciated securities, let's say they're taxed capital gain at 20%, you're going to avoid that capital gain. But again, if the two gifts are of the same value, you're saving 20% versus 37%, because one's ordinary income, one's capital gains. Now, if you do itemize, Susie, do you want to maybe address how that would work?
So if you do itemize, it probably makes more sense to give the appreciated asset, because then you can take the deduction of up to 30% of your adjusted gross income. And again, as Ellen said before, if you can take that over 5 years if you need to, and you can carry it over. And So you'll be able to take the deduction and you'll also be able to avoid the capital gain. So where you do itemize, again, what you'd want to check with your advisors and everything to be sure and compare, but generally speaking, that's what I would suggest.
And then just to sum that up, you're also going to look at the big picture, because we also talked about the benefits of saving assets like appreciated securities to leave to your family at your passing. So, you are most likely, if you itemize, your current income tax benefit is going to probably be better if you use the appreciated securities. But then again, if you're looking at your long-term planning, figuring out what you might want to leave to charity and leave to family when you pass, you might choose to start using up those retirement assets during your lifetime, since they're never going to avoid being taxed if they go to family.
Absolutely.
So, it's a balance, and we can work with you to help think about these various options and help your advisors as well.
Thank you. Thank you so much.
Go to the next question.
Yes, absolutely. And this is one we hear about pretty frequently, is real estate. And I'm so glad someone submitted this during the registration process. And we didn't have a lot of time to touch on real estate today. We hope to cover that in another session sometime. But really quickly, would a percentage rather than 100% of a property be acceptable as a gift to the institution?
Take that.
Yes, Kristen, I will take this one.
Amanda handles most of our real estate stuff.
I handle the majority of our real estate, yes, so I'll take this one. I think, and I'll say at the outset too, such a thoughtful question. So glad this was asked. And I hope that these are helpful to you. And if there are issues like this and you'd like to see, real estate as a separate topic, please reach out and let us know, shoot a quick email or anything, so we know, what topics are on your mind. But the short answer is yes. We could take a fractional interest, we could take the entirety of the interest, but there are some strings attached to, and so I think people really need to be aware of letting the university know that this is coming, making sure that this is done and we're advised before any purchase order or purchase contract has gone through. And you have to have a qualified appraisal as well. And so that's a piece that people sometimes forget about. So there's a lot of really fun ways to deal with real estate that can, not only you have that real estate during your life, you can give it to the university, you can wait until you're passing. There's so many different options and ways to do it. It's just a matter of your personal preference and your personal passions. But yes, we could do fractional and we can do entirety.
Excellent. This one is a great, really quick one I can answer right away. Does the university retain or sell securities it receives? So we get rid of those pretty quick. We liquidate as soon as we receive them in almost all cases. And that's just, due to volatility, things like that. We want to make sure that we're liquidating those assets as soon as possible. Our next question that came in: what do you do for a gift out of a trust or estate when the recipient is a fund or scholarship or a department that no longer exists? How would the university assist a trustee or an executor in redirecting a gift or helping to redesignate that? And I'll let our panel go ahead and answer.
Do you want to start, or do you want me to?
Sure, I can start. I think we take all of these so seriously, and I think at the threshold, the language is the key part.
Right.
The department might no longer exist, but it might be known by a different name. And one of the examples I thought of when I saw this question come through is the Department of Geology is now known as the Department of Earth, Environmental, and Planetary Sciences. So while that, quote unquote, geology department doesn't exist, another might. So when we are able to look at that language and see where the gift is, then we can identify, is there a successor department? Is there a successor scholarship recipient that could be identified? So 100% look at that language first. The other thing we do, we work with our Office of General Counsel, also seemingly on a weekly basis, to go through the trust documents and see what we can track down and if there is an issue of law or fact that we can help solve. If The language itself doesn't give us any indication. If working with general counsel still leaves some questions, we also can work with the Attorney General's office to make sure that we can do that change of purpose. But I think the most important thing our alumni should know too is we take these all so seriously.
Absolutely.
President Kaler is always intimately involved. He wants to know about these gifts and wants to make sure that, you know, we're implementing them in the right way that has the impact at the university.
So I would add to that, what Amanda's saying is so true. I mean, we handle a lot of estates that come in, and we're always looking at what was the donor's intent. That is the primary thing. And even sometimes when we don't know what the donor's intent was, we look at the history of the donor. We look at what their relationship was with the university. But I would say, you know, if something's in a trust or will and the person dies and we're left with whatever is in the document, we will go through all of these processes. But it sort of points out the true benefit of talking to us in advance, if that's at all possible. I know that's something, Susie, that you encourage your clients, and I used to, because sometimes a client has in their mind something that they want to do, but it may not be something that the university either can do or doesn't meet our needs, and we want to come up with a way that's going to meet your goals and the university's goals. So sharing the, I mean, sometimes people are very private, we understand that, but if it's possible to share that gift in advance, then we can work with the attorney to make sure the language reads in a way that will be workable.
Absolutely.
Kristen, I'm going to lob the next question to you.
Okay.
So thoughtful. What happens when the university receives gifts that are not designated for any purpose?
That is a great question. Also, and you covered some of that, and again, we cannot reiterate this enough. We take this so seriously. I can't tell you the number of times that, you know, we will get an estate gift that comes in and there's not really a clear designation. It just says to Case Western Reserve University. And Amanda and Ellen and I do our absolute best. We comb through the archives, we comb through records, through giving history, and we really learn about the person who made this gift. We take it very, very seriously to make sure that we understand who this person was and what was important to them during their time at the university and throughout their life. So learning about them from their family members, from executors, you know, reading their obituary, finding anything else we can about them in our records here at the university. And we compile all of that information. We work with our Office of General Counsel to really thoroughly go through all of those records. And when we can't determine what it is, if there's no information available as to where this gift should go, we send that up the ladder to President Kaler, in fact, and he does a thorough review of all of that material that we've done our homework on to help make that designation in the end, to make sure that it's something that that person was passionate about, at least that we can tell from all of the evidence that's available to us. So that's sort of where we go from there.
Excellent, excellent. Well, I think we have a few more questions too, and I don't know that we have the time to cover them. So as I said at the outset, we're going to get back to everyone who asked the questions and really try to push something out too so that you have the answers. And if you have any more questions, please know that we're all available to answer those. But I think, you know, I'll have everybody do some final parting thoughts, but just thank you so much for your time, for your attention, for your loyalty to Case Western. It really is a fantastic institution, and we hope these seminars are helpful for you. If there are ideas or topics or things that you want to vet or go over with us, please let us know. We really love input. So thank you for joining us today, and I'll turn it over. We'll go in order. Ellen, any parting thoughts?
No, thank you very much. We hope that, you know, we've given you food for thought, answered some of your questions. Always able to ask more questions, answer more questions. Susie, thank you so much for joining us.
Thanks for having me.
Your insight is really helpful.
Yeah, no, thank you for having me, and I really like working with this team, and I think it's very important to work with both the university and with your advisors.
Absolutely. And to that end, we actually have our final slide here. We'd like to share our contact information with you all. If you'd like to reach out, if you have questions that were sparked by this, or maybe we weren't able to answer them, and you have something very specific you'd like to talk through with any of us, our contact information is right there. You can call us, you can email us. Our individual email addresses are available, and we will gladly sit down, have a cup of coffee with you, talk through whatever it is, and find a way to make you happy with being able to support the university in whatever way you can. So thank you so much for joining us today.
Yes, thank you.
Thank you.